Anthony Grasso here, bringing you financial news you can use. In this video, I'm going to do a stock analysis on TherapeuticsMD. I'm going to go over a summary of the company. I'm definitely going to let you guys research the product offerings. I'm going to go over some recent news, financials, analyst projections, and give it my buy, hold, or sell recommendations. So let's get right into it. So TherapeuticsMD is a small cap pharmaceutical stock company that focuses on women's health issues. There you go. You can search that. And the company's still in the early stages of growth right now. TherapeuticsMD is a major drug manufacturer with a focus on creating and commercializing products targeted exclusively for women. The company intends to commercialize advanced hormone therapy pharmaceutical products. TherapeuticsMD's drug candidates that have completed clinical trials are designed to alleviate the symptoms of and reduce the health risk associated with menopause-related hormone deficiencies, including hot flashes, ooh, it's hot in here, osteoporosis, and discomfort. The company relies on third parties for the production of clinical and commercial quantities of its drug candidates. I will not specifically get into the products themselves, guys, so I'll let you look them up. So let's go ahead and look at some news of the company. So there's not a lot of news of the company going on right now. The only recent news was a stock offering back in November 2020 that diluted the shares. They got about $30 million from it. So TherapeuticsMD intends to use the net proceeds from the offering for commercialization of its 3 FDA-approved products, and you can read through it yourself. You can search it. And additionally intends to use a portion of the net proceeds from the offering for working capital and general corporate purposes. But let's get into the fundamentals of the company, because that's what we all want to know about. So the company's total revenues were slightly declining from 2016 to 2018, going from 19 million to 16 million in 2018, and then skyrocketed to 49 million in 2019. And the company is projected to have about $64 million in revenue by the end of 2020, but with a negative earnings of $170 million. So they're getting 64 in revenue, but they've spent so much money, so that's a huge loss right now, and they're definitely in the red. Now, by the end of 2021, it's projected to have 146 million in revenue with a negative earnings of 79 million, but that all changes with the projections beyond 2021. The break-even year is projected to be sometime in 2022. The projections going out to the end of 2025 have the revenues growing per year over year to $634 million in revenue by the end of 2025. Let me repeat that. $634 million in revenues projected. And they should have a positive revenues of of earnings. They should have a positive earnings in 2025 of $280 million. Think about that while we go through the rest of this video with a stock price of only $1.44 right now. One analyst software has this company below fair value with an estimate of fair value of $24.50. I don't really agree with that based upon a few of the things I'm going to discuss within this video. Right now, the stock price is at $1.44. It's definitely had some volatility. It's all gone up as high as $2.24 recently in the past 6 months, but it's definitely been on the decline right now, and it's definitely had a rally going on right about now. So I'm going to bring it back over here. So there's kind of a huge difference right now in the stock price, but there are some reasons I can see at the moment between that analyst projection of $24 of fair value and $1.44 it's trading at right now. The gross profit margin for the third quarter of its fiscal year 2020 has decreased when compared to the same period a year ago. Sales and net income have dropped, underperforming the average competitor with its subsector. Now, it's extremely liquid company. Currently, the quick ratio is 2.19%. or 2.19, which clearly shows the ability to cover any short-term cash needs right now, but that's short-term. But going into 2021, they're going to have issues of needing cash. Now, if we look at the valuation analysis, because the earnings of the company are not available right now for the end of 2020, the price-to-sales ratio is the most appropriate valuation measure. The PE and the PEG ratio is not meaningful due to the company's negative earnings right now. Therefore, the company seems fairly valued with the price-to-sales ratio of 5.53 times. That is in line with the pharmaceuticals industry of median of 4.9 times. Now, let's look at some profitability analysis. All through losing money on an operating basis, the company typically, its profitability characteristics for a company in the pharmaceuticals industry While it is better than most at converting revenues to profits on a gross margin basis, its net revenue is only on par with the industry norm right now. So looking at the growth analysis, the company saw earnings decline in spite of positive revenue growth during the past 12 months. However, this performance was on par with the typical company in the pharmaceuticals industry right now. And let's look at the financial strength analysis. It's a very weak balance sheet. And when I mean weak, I mean like bad weak. Highlighted by this negative owner's equity, significant negative owner's equity right now. Most likely this was caused by cumulative losses which negatively impacted retained earnings. Yeah. Additionally, this company's debt load outweighs its assets while day-to-day operations are losing money right now. And they're going to be losing money for the next year and a half now. One plus is that there are enough liquid assets to satisfy current obligations. However, this situation is unsustainable over the long run, and the company has considerable financial risk. Yes, the company has considerable financial risk, but I'm going to go in later in the video to explain how they're offsetting that financial risk, because it's either they sell something or assets they have, or do another stock offering to get another $30 million and dilute the shares even more. But I'll discuss that later on in the video. The company currently is unprofitable and losses have increased year over year for the past 5 years at a rate of 21.4% per year. But on a positive news, the company is expected to become profitable in the next 3 years. I say by mid 2022, you should break even to a profitability analysis based on the projections of the company. The company's revenue is projected to increase about 38.6% per year. The company does have a high return on equity, though. The liabilities exceed its assets, so it's difficult to calculate a return on equity. So if they don't turn this situation around, this could be the end of the company. Yes, it could be the end of the company, but it's not, and I'm gonna go explain why. Or we may see some stock sales and more dilution of the company in the future, or the sale of VitaCare, but I'll get into VitaCare later on. That's very important. So the company has about a year of cash runaway based on its current free cash flow analysis. So cash is definitely going to be needed. I keep repeating this, but yes, this company is going to need a lot of cash in 2021 to stay afloat. So what do the analysts say about this company? 50% of them are a buy, 28% are a strong buy, and 14% are a hold. And that's when I was logging into the trading platforms. The analyst price targets right now are about $10 on the high end, $3 on the low end, $6.43 on the average. The stock is currently trading at $1.44, so there might just be potential of a breakout in this stock, but I will get into my thoughts on that later. There are multiple rating agencies, though, that have analyst projections of a strong sell rating on the stock because of the fundamentals of what's been happening to the company, and they're not really looking at the forward projections on how the company is going to get out of their current hole. So just notate that. The ownership breakdown of this company is 9.1% individual insiders, 53.8% institutions, 37.1% general public, and private companies own 0.001%. So let's look at what the insiders are doing. Are they buying or selling the stock? Insider sales basically have been known to precede tough periods for the business. I would never suggest, though, that investors should base their decisions solely on what the directors of the company have been doing, but it's perfectly logical to keep tabs on what the insiders are doing. For example, a Columbian University study found that insiders are more likely to engage in open market purchases of their own company stock when the firm is about to reveal new agreements with customers and suppliers. In the past 12 months, TherapeuticsMD insiders were buying shares, but not selling, in the tune of 207,000 shares. That was back in June of 2020, so nothing's happened since June 2020. And there's been not any insider purchases or sales since then. So am I a buy, hold, or sell recommendation on this company? Here are my thoughts before I get into that. So let's go over the bears and the bulls, because we have to discuss both of them. There's pros and cons here. Now on the bear side, they say it's a sell because of multiple weaknesses, which they believe should have a greater impact than any of the strengths, and could make it more difficult for investors to achieve positive results. The company's weaknesses can be seen in multiple areas, such as its deteriorating net income, weak operating cash flow, and generally disappointing historical performance in the stock itself. This is all true. Can't deny it. Currently, the company looks very bad to touch with a 10-foot pole looking at the fundamentals over the historical period. Yeah, that's true. Can't argue with that. Before I can say I'm a buy, hold, or sell, though, I have to examine a few things. What's the likelihood of the company with the projected revenues the analysts are saying the company will have in the years to come? Should we believe that those projections are anywhere close to reality for the stock valuation and analysis? Those numbers, again, let me repeat that, are by 2025, the revenues are projected to grow year over year to $634 million with positive earnings of $280 million. That's huge. That all being said, I am not a bear on this stock because of its potential, and I'm not a strong buy either because of the company has dug itself in a huge hole this year. Now, in addition to commercial and financial progress, the company was able to work on some executive deals that could help alleviate some pressure in the near term. They definitely need it. Firstly, TherapeuticsMD was able to negotiate with their lender, who has agreed to lower the minimum cash balance requirement from $60 million to $45 million through the end of 2020. It appears the company will be able to hit their Q4 earning covenant with their lender. In addition, the company is looking to divest VitaCare to unlock some non-dilutive financing. As I said earlier, they're going to need $30 to $50 more million to stay afloat in 2021. So when I said earlier they need to have another stock sale or sell part of their company. TherapeuticsMD announced that they're looking to divest the VitaCare Prescription Services, which is the company's data and patient services hub. The company believes that the COVID-19 pandemic has put a spotlight on the value of the pharma companies being able to connect with patients, so there is some value in the service. According to TherapeuticsMD, they have recently received several inquiries with potential partners or sponsors looking to acquire a controlling interest in VitaCare. TherapeuticsMD has retained Greenhill and Company to help the company find the right partner for the VitaCare and generate the most value. TherapeuticsMD believes the value of VitaCare could be upwards of $100 million and can generate at least $50 million in non-dilutive proceeds while retaining an interest in the business. So if they're able to sell VitaCare, then they could unlock 50 million shares, and that would be half. They wouldn't have to raise any money with another stock sale and dilute the shares even more. That'd be a great thing right now. But be warned, we have no knowledge of how well the company's products will do in the future. Outlook looks extremely positive. Yes, extremely positive for the company. But that is a very unknown factor at this point. But based on all the information, so I'm taking the fundamentals, the projections, the current hole the company is in right now, and what they're doing to get out of it. Based on all that information, you know what I'm going to do? I'm going to roll those dice and say I'm a very speculative buy on this stock with a 5 to 10 year time horizon. Lock it and load, like you lock it and load it for the next 5 to 10 years. Betting on the VitaCare deal sometime in 2021, I could see this stock getting to the $7 range by the end of the year or early 2022. But if that is too risky for you, you should wait for more information in the next few months to see if a deal can actually be reached to sell off VitaCare and really examine, can this company dig itself out of the hole, or are they going to dilute the shares even more? So either they're going to get out of the hole they dug, or they're going to dig it deeper, or they're going to dilute more shares. So that's where we're at. I consider this stock a highly volatile and risky, and you must have a extremely high paying risk tolerance to invest in this company. But if the numbers become truth, it'll be the hugest windfall by 2025. My anticipation is that this company becomes the leading women's healthcare brand. So there you have it, folks. Now, don't forget to smash that like button down below. It definitely helps me out in the YouTube algorithm. And always consider subscribing if you like to hear more financial news. You can benefit you. I do a lot of stock analysis, 2 to 3 to 5 stocks a day. I'm going to try to get up there. Now, until the next stock update later today, or maybe tomorrow morning, I'll talk to you soon. Ciao.